and a bunch of silver trades in China. China, in addition to being a large silver producer, is the largest refiner in the world. About 65% of the world's refined silver comes out of China, which means that Chinese export sanctions don't just apply to silver produced in China, but rather silver processed in China. And the Chinese apparently have come to believe that silver is, like other materials, as much an industrial and strategic material as it is a monetary metal. Now, you have to read a couple of other things into the Chinese action. They banned silver exports from China, except for companies that were licensed by the Chinese state, which is to say their friends and relatives. These stocks are cheaper than they were at half the price. The move in the gold price from $3,000 to $4,200, yes, it's a $1,200 move on a $4,000 base, which is a 25% move or something like that. But it's all margin. If these guys were breaking even, totally breaking even, including cost of capital at $2,000, they had a $1,000 an ounce margin at $3,000. They have a $2,000 an ounce margin today, which is to say their margin has doubled while at the same time their reserves and their production has increased. If you believe the gold price holds, these stocks are cheaper than they were when the stocks were selling for half the price. This is pretty compelling arithmetic from my point of view. Now, that's predicated on the fact that I believe that the gold price in nominal terms, I keep saying nominal, in US dollar terms, increases. For the very large buyers, like my former employer Sprott, where I'm still the largest shareholder, when they need to buy lots of silver for the Sprott physical trusts, they can buy it. When retail people try to buy 1 ounce bars or 10 ounce bars through retail channels, they have a very difficult time. And there is structural disruption in the traditional silver markets, in particular in the COMEX, which is a paper market. That market was structurally over-leveraged. Some days, the market traded contracts that were equal to 200 times the amount of silver available for good delivery. It didn't matter for 50 years because the silver didn't deliver. The paper contracts settled in paper. They were rolled over. What happened just very, very, very recently is the LBMA and European markets found themselves structurally short of silver. And the spot price for silver was 4 or 5% higher in London than it was in New York or Chicago. So people started taking delivery because they could make 4 or 5% overnight. Simultaneously in the U.S., the lease rates for silver. Many people don't know that there's a lease market for silver for jewelers and industrial users, fabricators. The lease rates went from 3.5% or 4% to 40% because the people who had been holding silver for lease, myself included, at the end of the lease term, which are very short term, sent the silver to London to make 4% overnight. These are disruptions that are temporary in nature. The disruption that's less temporary in nature, I think, is the coming multipolarity in silver markets. The silver used to be controlled in London and in the U.S., New York and Chicago. It's estimated now that 25% of the physical silver that trades in Dubai. That's a big, big, big change. And a bunch of silver trades in China. China, in addition to being a large silver producer, is the largest refiner in the world. About 65% of the world's refined silver comes out of China, which means that Chinese export sanctions don't just apply to silver produced in China, but rather silver processed in China. And the Chinese apparently have come to believe that silver is, like other materials, as much an industrial and strategic material as it is a monetary metal. Now, you have to read a couple of other things into the Chinese action. They banned silver exports from China, except for companies that were licensed by the Chinese state, which is to say their friends and relatives. I also might mention that outside of the monetary realm, where I'm more conversant, silver delivers a lot of utility in fabrication processes. My good friend Frank Giustra quoted a source suggesting that there's no demand elasticity in silver use for solar up to $135 an ounce, which is to say the reflective properties of silver and the ease with which it is used to coat solar panels means that no significant substitution and no significant fabrication changes will come into the market unless the silver price goes above $130 an ounce, $135 an ounce. So it's important to note that the utility of silver in applications like germicides, water treatment, and solar means that there's a lot of structural inelasticity around demand. You will see some increase in primary silver production. That will happen. But primary silver production last year was about 18% of total supply, well after recycling and byproduct production. I think that looking out over 5 years, the increase in the copper price will have a lot more to do with increased silver production than the increase in the silver price. If we were ever to see, again, a good market for lead or zinc, there's a lot of silver produced as a byproduct of lead and zinc deposits. Increases in copper, lead, and zinc production would have more of an impact on the supply side with regards to silver than increases in the silver price, paradoxically. Where the increase in the silver price really comes into play, and I remember this in the 1990s, a fairly large amount of physical silver is held outside the market in India. And if you have increases in the dollar quote in silver, combined with a decrease in the rupiah quote in US dollars, you get a parabolic move in silver in India. It's held as a store of wealth by poor people. Back when you were a very, very young man, I dare say a boy, Warren Buffett owned 15-20% of the world's above ground stocks of silver. When the market found that out, the market doubled and then, went up another 50%. And all of a sudden the market crashed. The Indian rupiah fell by 50% against the US dollar. And the silver price was up well over 100% in US dollar terms. So silver in Indian terms, in rupiah terms, was up by 400%. I think that could be. It really depends on, things are apparently, I'm not an expert on India, things are getting better in India. So it could be, on the other hand, that an increase in wealth in rural India in particular leads to a structural increase in silver demand. I don't know the answer to that. I'm speculating. I do know from having been to Dubai a lot that a bunch of the physical demand for silver in Dubai is Indian, either from Indian guest workers or from, how would you call it, fishermen. It seems that there's an excise tax on silver, and sometimes Gujarati fishermen in Dubai set off from Dubai with fishing boats that happen to have some silver, and fishing boats from Gujarat set out in the Indian Ocean, and they meet. And somehow Dubai silver becomes Indian silver. I would note that since 1913, the year of the establishment of the U.S. Federal Reserve, the U.S. dollar has lost 97% of its purchasing power. So the idea that it will lose 3/4 of the remaining 3% doesn't seem outlandish when you look at history. Particularly when you look at that history and you look at our on-balance sheet and off-balance sheet debt and deficits as a percentage of gross domestic product, or better yet, as a function of gross outputs. The circumstances that we have in place today are more egregious circumstances, arithmetically, than have occurred during a century-long period, better than a century-long period, where the purchasing power of the dollar has been declined by 97%. Let's look at what would it take to reverse that decline, just for fun. That's how you test a thesis, right? To begin with, you'd need a balanced budget. You would need to erase a $2.5 trillion on-balance sheet deficit in the United States. Fat chance. You would need, secondly, to figure out how you were going to deal with the $38 trillion in gross encumbrances. $36 trillion net. In other words, how you're going to pay off the bondholders, particularly because $9 trillion of that debt needs to be refinanced in the next 12 months. Then, how do you deal with $120 trillion in net present value of entitlements? Medicare, Medicaid, Social Security, military pensions, federal pensions. How do you deal with that? Are you honest? Do you send a letter to some old codger like Rick Rule and say, yes, you've paid into Social Security for 60 years, but no, you're not going to get any money? Old guys vote. That outcome looks problematic to me. What I think we do is we do what we did in the decade of the 1970s. You're too young to know this, but let me tell you what we did. We'd fought 2 wars in the 60s. We fought the war on poverty, which we lost, and we fought the war in Vietnam, which we lost. And what we had left over was a bunch of debt and deficits. And it was politically unpalatable to say to various creditors of ours, either bondholders or entitlement beneficiaries, that they weren't going to get paid. So what we did is we honored the nominal value of our obligations while inflating away the net present value of the obligations. We reduced the purchasing power of our obligations by 75% in 10 years. My suspicion is that passes prologue. If you did that, you would reduce the real value of U.S. obligations, the purchasing power of U.S. obligations, from a gross total of, $155 trillion down to some number like $35 or $40 trillion. That's not such an ugly number. It's ugly for the people who were bondholders. and it's ugly for the people who rely on entitlements. But it seems to me to be the only arithmetic way out of this fiscal trap that we've put ourselves in. Of course, Mr. Trump says he's going to grow the economy out of this. Do you know that I've heard this out of every president in the United States since Eisenhower? You may not even know who Eisenhower was. He was so long ago as a president. The one who came closest was Reagan. Reagan, despite